Well, stocks are continuing to fall a little over an hour into the trading day, with investors focused on that hotter than expected CPI print and the jobless claims data. Joining us now for what's next for the market, we've got Max Kettner. He's the chief multi-asset strategist over at HSBC. Max, always great to have you. I want to start on the risks to inflation here. Did that CPI print make you think that there is a bigger risk than previously about inflation rearing its ugly head again?
No, not really, because we've never really been in the camp that it's going to completely die and completely go away anyway. I think the market is basically, and has been for the best part of the last year and a half, almost 2 years now, been really always exaggerating around inflation. It's either been saying inflation is completely dead, it's yesterday's story, let's move on, or it's been doing the entire opposite. Like, we've had perhaps in March, April this year, and in the first quarter this year, obviously had the same time last year as well, where yields were going towards 5% in the US. And I think that's what we're seeing again a bit, that people are freaking out a bit too much. But I do think that also, particularly on the rate side, the terminal rate expectations are still perhaps a little bit too low, that there's still a bit too much bearishness from the third quarter around US growth and around US inflation in the price. Because when we look at underlying inflation, the last 2-3 months, supercore inflation runs the last 3 months around 4.5%. That is clearly too high, and that should give the Fed a bit cause for concern that yes, they can continue cutting rates, but not down to the sort of 2.5-3% level that the market was pricing in just a couple of weeks ago.
So Max, and what do you think that pacing should look like?
I think it's probably 25 basis points pretty much baked into the cake the next 2 meetings. Then probably even in the first quarter also in every single meeting. I think once we get below 4%, then it's starting to get a bit trickier, right? Should we go really all the way down to 3, or should it be stuck somewhere closer to 4%? Now that's something that we've got to deal with in 6 months' time. Perhaps by then really inflation will have been stuck around a bit more around the 3-ish% core PCE level. And by then perhaps we will realize, yeah, we're not going to go back to those levels where we were pre-COVID, or perhaps even those levels that the Fed still sees at neutral, those slightly below 3% levels. I think they are still really off the table for the time being, really.
Well, you say that the terminal rate expectations are a little bit too low. It makes me think about what we're seeing in the bond market, which hasn't been a problem for equities, right, at 44th all-time high for the year. And we're still seeing credit spreads tight, investment-grade bonds tightest since 2021. How long can that keep going?
I think it can keep going up to the point where the Fed not only would say, this is not only a pause, but we're done. And the market may then perhaps even extrapolate that as, oh, are they done? Or may they even have to hike again? I think that is the point where equities and where credit spreads, where emerging markets, so risk assets in general really start getting in trouble. Because that's exactly what we've seen in March, April this year. Remember, we had the dovish Fed pivot last December. And then January, February, March, every single time inflation was surprising to the upside. But risk assets didn't really care, even though there's fewer and fewer rate cuts than in the price. But as long as the market was still pricing rate cuts, risk assets were totally fine. They were starting to become a bit unhinged when it was really about, oh, they may not be able to cut at all, or they may even have to hike. We're far away, really far away from that. I think there is still a couple of months to go where genuinely good news continues to be good news. And only at the point where we start to talk about, okay, the Fed is really done with cutting. They're going to have to stop cutting way before than we thought. And they may even have to hike again. Then it would become a problem for risk assets.
Max, before we get your thoughts on the global and on the more macro picture, I'm curious just what your read is on the U.S. employment situation right now. Because I bring that up because that spike higher that we got in claims this morning, clearly that could be a one-off or maybe a couple weeks off here, considering the hurricanes and some of the delays that factoring into that. But how worrisome are you maybe about some of the weakness that we are seeing and the cracks that are forming? Is that almost not getting enough attention?
No, I think it's getting way too much attention, actually. I think when we look at the cracks, there's always going to be cracks. And of course, if the Fed starts hiking from 0 to 5.5, then, your weakest credit or delinquency rates in credit cards, delinquencies in mortgages, all of this stuff should be going up. But I think we're focusing way too much on it In fact, when we look at the revisions of the national accounts data from 2 weeks ago, that was painting an absolutely uber rosy picture of the US economy. So looking at the employment market, for example, the national accounts data now is looking like in the last couple of quarters, salaries and wages and incomes and dividend income, interest income, all of this stuff has actually been revised higher in conjunction with also personal and private household savings. So even the savings rate is now much higher. So I do think actually the cracks are getting too much attention. And what's not getting enough attention is how strong really the US has been and continues to be from a sort of overall macro and growth backdrop.
Max, I want to end on China. Huge bump in volatility there. What is your investment thesis on China? Is it going to continue to have legs to that rally, or was it just a stimulus sugar high that's going to go away?
No, we do think that it has some further room to go. I do think there is probably going to be more fiscal stimulus to come on the weekend, perhaps even later, but probably on the weekend. And that really should be a further tailwind for Chinese equities overall, because when we even already look at the short-term data from last week during a golden week, when we look at, land sales, tier one city activity, housing sales, even that already was picking up. So we've had not even a lag of like a month or something where stimulus measures, or that it didn't even take a month for stimulus measures to really feed through into activity data. It's already starting now. And I think people are still underestimating a little bit that the nature of this kind of stimulus is much more to really bring growth up. Whereas in the last 2 years, a lot of those stimulus measures have been more designed to put a floor under it, to not make the economy weaken further. But this time around, I think it really is a different nature, different kind of stimulus to finally bring growth on a bit of a firmer footing.
All right, Max Kettner, always great to have you, HSBC's Chief Multi-Asset Strategist. Thanks so much.